morning or good afternoon, everyone. Thank you for joining us in Wealth Council's virtual classroom. Welcome to our combined Word on the Street and Business Planning webinar on Business Valuation Essentials for Estate Planning Attorneys, led by Evan M. Levine and Nanish Shah.
Thank you so much, Monica. And I want to extend thanks to Sarah and Jenny as well for organizing this program. Also, a special thanks to Jim Wolverton from Elder Council, who made the introduction originally. We're honored to spend some time with such a distinguished group this morning. Again, my name is Evan Levine, co-founder of Complete Advisors. I'm joined by my partner, Nanish Shah. Complete Advisors is a business planning and valuation firm, and we have a special focus on preparing complex business valuations for estate planning attorneys, business attorneys, other advisors, and their clients. We can value any business, public or private, and we could also value other assets, including entities that hold real estate, SPACs, which is an acronym for Special Purpose Acquisition Company, hedge funds, private equity, intellectual property, limited partnership interest, and more. So to give you a roadmap for today's program, I'm just going to spend the next 5 minutes or so introducing our topic on a high level. I'm going to turn it over to Nanish Shah, who'll dig in for about 35 minutes into more detail on the topic, and then he'll give it back to me for a 5-minute wrap up and a Q&A. So, as most of you know, a business owner will typically have anywhere between 50 and 80% of their net worth tied up in their business. So it follows suit that any discussion about retirement or estate planning needs to start with an assessment of the business. And the assessment of the business is a professional valuation. All tax and estate and legal planning flows from the professional valuation. And various studies have shown that a high percentage of owners have not had their business valued professionally in the last 5 years. We expect that to change as the baby boomer generation continues to move to and through retirement, and they increasingly think about succession planning and retirement planning and estate planning. We feel that they're going to be turning to their experts and other advisors to have their business valued professionally. There are so many valuable applications to a professional valuation. In addition to estate and gift tax planning, which we're going to spend a lot of time on today, there are so many other valid reasons to have a business valued. I think of it as like the valuation as the Swiss Army knife document, particularly for a business owner, whether it be creating a buy-sell agreement or divorce proceedings or negotiating with lenders, hiring employees, issuing stock options, intellectual property disputes, on and on. So many uses and purposes in the marketplace for a professional valuation. Now, one quick programming note: in the course description, the course highlights included understanding customer-based corporate valuation, valuation enhancement services, and a software review. We decided last minute to take that out just because we don't have enough time. So those three, the CBVC, valuation enhancement and software review, will not be covered, but you could always reach out to us separately if you'd like to discuss that. So now I'm going to introduce you to my partner and good friend, Nanish Shah. Before we met, Nanish spent 25 years on Wall Street honing his skills as a business valuation specialist. He's valued hundreds of companies, both public and private. In fact, Nanish came up with a method for valuing Apple that became the gold standard on Wall Street, and it was cited by Tim Cook several times after Nanish thought of it. Nanish is a true business valuation specialist. He's a subject matter expert. He has a knack for taking complex ideas and making them simple. And he's also very approachable and a heck of a nice guy. So with that, I'm going to turn it over to my partner and friend, Nanish Shah.
Thank you, Evan. That was really nice of you. Thank you, Monica, and thanks to Wealth Council for setting this course study work up for us. I wanted to start with this cartoon. And the cartoon is, in the valuation world, you're always looking for the final number, and that is the answer. But then the question is more critical. And questions that you ask the analyst, that you ask the client, and that you might be able to ask expert if the valuation goes into court, that's what we are trying to talk about today. So this course is the introduction to valuation. And I don't expect anyone to leave this course and then become a valuations expert. But what I really expect that you take out of this course is what are the right questions to ask to different entity that you come across during valuation process. It could be client, it could be prospect, it could be analyst, and as I mentioned, it could be an expert that you are cross-examining during the court case. And these are the questions. Any good analyst starts with why. Why do you want to get the valuation done? Then you think about how you're going to get there. When do you want this valuation for? What is the process that you're going to apply, and who are the different players in the valuation space? And I'll touch on all of that and go into detail, but let me introduce a case that has been in the news recently. This is the case from music industry. Prince, as all of you know, died 5 years ago due to drug overdose, but he didn't die poor. He had multiple tens of millions of asset and net worth. Had a real estate, had rights to the songs. He had they call it Prince Vault. They had songs which were not published, and he owns a music company. The bank which handles, but what happened though is Prince didn't have a will, and he didn't plan for his estate. So the bank which handles net worth of Prince's estate, they came up with a valuation of the total value of the what that net worth was at $82.3 million. When our IRS looked at it, they came up with a valuation of $162.3 million. Big difference. And I want to introduce this case, and we can go back to it as we go through this course and refer to different items that can apply and what are the questions that you should be asking. So let's get into this. Why? Why is the question for your client, your prospect, or it's question for you? Why do you want to get the valuation done? That is the core question that will drive everything after that. So you're looking at the purpose. What is the purpose of the business valuation? And as Evan mentioned, it could be tax related, it could be M&A related. You know, you're buying or selling a company. It could be financial accounting related. You're just focusing on one aspect of intellectual property. So in case of Prince, for example, Prince owned rights to music. He owns rights to his name. That's intellectual property, and that should be valued. It has to be valued separately. It can be litigation. It can be divorce, insurance claim, shareholder dispute, all of that. So purpose is a critical part, core part of the valuation. That's where you start. Once you know the purpose of the valuation, it kind of drives the premise of the value, which is the business or entity that I'm valuing, is it a going concern? Am I just valuing asset? If it is only a building or a house or just real estate, you're valuing just asset. Is it a liquidation situation? We recently are valuing a company. It's a bridal gown business. And because of the COVID, it just changes the business. And now it's at the point where they don't know how it's going to unfold. And that could be a situation where it's going to be orderly liquidation or a forced liquidation. But this is what client and you have to decide. What do you really want to get to? Once that's defined, then it becomes clear whether the business is minority owned or is it controlled, because valuation for those two different type of ownership is different. Is it marketable? Is it non-marketable? Usually, private businesses are not easily marketable. On the flip side, public businesses are marketable. You can always find a buyer or a seller of a public security. So that level of the value is a driver as you go forward in the valuation process. Going back to the Prince case, most of his assets are not easily marketable, but most of his assets were controlled by one owner, and that becomes a non-marketable controlled entity. Once you have the purpose, the premise, the level of value, that will define the standard of value. The standard of value can be different. It can be fair market value. It can be fair value. It can be just a strategic value. If somebody's buying a business, the value would be different depending on how that business changes the long-term strategic business of the buyer. It can be just a fundamental value. You're just trying to understand what is the intrinsic value of the company, not for any other purpose, but just to invest small amount of money. And that's usually how public companies are valued. Let me introduce IRS revenue ruling here. I'm not going to introduce a lot of revenue ruling, but this is the most critical revenue ruling that came about in 1959. It's the IRS revenue ruling 5960. It's thought of as a most valuable piece of literature that came out. It outlines the methods and the factors that one should be using. And although it's involved with estate planning and gift taxes, but it can be applied to many different scenarios. And it provides you the valuation formulas and methods. So this was, I'm going to paraphrase this, but basically this ruling says there's a hypothetical buyer, there's a hypothetical seller. They have the full market information and what price they will sell that business at. That's what you are trying to come up with. And so from going back to the Prince case, the hypothetical buyer and seller is valuing that asset at 160 million roughly from IRS perspective, and about 80 million roughly from the Prince's bank's perspective. Big difference, and we'll go into detail on where those differences can arise. So now this is the date of valuation. When do you want the valuation for? In case of Prince, this was as of 2009 or so. I'm sorry, as of the date of his death. But you have a client. They are thinking about transferring asset into a trust account. They have to come up with a date that they want to do this at. COVID is a change that happened that has changed the value of the business significantly. Some big businesses, a lot of businesses have gone down in value. So if you think about travel industry or entertainment industry, the valuation gone down. The value of those businesses as of December 31st of 2019 is significantly higher than as of today. Some businesses have gone up in value. Like I know a liquor business, they own 10 different stores in Long Island here, and the business revenue has gone up. So, but the critical factor in knowing the date is everything that happens after that valuation date is not very relevant. But everything that has happened up to the date of valuation is critical in the analysis of the valuation. And this cartoon, as this cartoon shows, you can't just pick a day of the highest revenue or highest profits so that you can have a higher value of the business, or you can pick on the flip side, you can pick lowest revenue and lowest profit so that you have a low valuation. This kind of leads us into how the valuation will go about and what type of approaches and valuation methods we're going to use. But before we get into that, I want to introduce another case. It's the case of estate of Aaron U. Jones. Aaron U. Jones owned a sawmill and timberland of significant value. He decided to transfer part of that value to his kids. The timberland and the sawmill were a separate company, but worked as a one entity, and they had a cross ownership. They had a common headquarter. They had a common management. When IRS, when Aaron U. Jones transferred the asset, the valuation they came up with was $21 million. From IRS's perspective, they were thinking of those two entities as a separate entity, and they were valuing them as a separate entity. And they came up with a valuation of $121 million. Again, as similar to Prince's case, big difference. Now, question is, how do you resolve that? And this case was resolved in June of 2019, and in a way, it was a really interesting case, so that it gave us an idea about how to think about different aspects of the business valuation. So this is the how question is for the analyst. Analyst has to think about how are they going to go about valuing different type of a business entities and different type of assets. So first thing analyst has to do is has to think about top-down work. Top-down meaning you do economic analysis, you do industry analysis, and you understand the company very well, and then you try to use numbers to come up with a valuation that can make sense. So, for example, with the Aaron U. Jones, the industry is lumber or timber. The industry can get impacted because of changes in the national economy. It can even get impacted because of changes in international economy. But you have to understand what different aspect of economy can impact lumber business, and then you have to use that information to reference that into the valuation. By the way, in case of Prince, the valuation, the industry is music, which is quite different than the lumber, and it can be impacted by different type of information. So economic data that can impact lumber business is completely different than the economic data that can impact music business. The structure of industry is critical to understand. What you're driving here is to really understand the business at the point where you can make good judgment about the valuation of that business. So you understand the structure, you understand the trends that can impact that industry, you understand the life cycle of that business and the seasonality of that business. Lumber business could be seasonal, and the revenue might be going up in spring and summer, where music business might not have as much seasonality. So to really grasp the business and understand how it operates and how it behaves, you really have to understand the management, its history, and the cost structure. because all this comes into play when we start looking at the numbers. You are also looking at the pricing power of that business, the margin analysis. You are looking at strength and weaknesses of that business, opportunity and threats. So in case of music industry, for example, the threat could be change in how music is delivered. There was a time it was all on CDs, and now we don't listen to that, and we just listen to the Spotify or something similar. This is another cartoon that makes sense. Is business might be making money, might not be making money, and as an analyst, what you are trying to understand is all aspect of different component of the business. And once you understand, then you get into the quantitative analysis. So first part was a qualitative analysis of a business or entity. Then you do the quantitative analysis. And from your perspective, from advisor's perspective, you want to make sure that you have an analyst who can do this, or at least you understand to ask the right question. The quantitative analysis is really the nitty-gritty that you go into. You are trying to learn the financials. Not only that, what you're also trying to learn is how financials are changing over time, how financials or numbers are related to other companies in the industry and are related to other businesses in the local area. So you look at the 3 to 5 years of historical numbers. You try to match it by using common size analysis or a trend analysis or a ratio analysis to compare it with the industry averages or a specific company. And all of this data, so there's a set of data that you receive from the client, and there's a set of data that you can access through different database and then make a comparison. The other thing that you have to do, depending on whether you are analyzing the business for control and a control owner or a minority person, whether you are trying to, are there any discretionary expenses that has to be adjusted? You are also trying to readjust the financial so that any extraordinary items or non-recurring items are out of the analysis. But what you are trying to get to is what is the pure economic benefit that the entity is receiving, and that becomes your starting point for one type of valuation. So, for example, if you have a severe impact of climate or weather that impedes your business, that's one-time item and it should be adjusted. If there's a non-operating item in the business, say on your balance sheet, you have artwork that's not really generating any revenue, that needs to be adjusted properly. And any off-balance sheet items. So you might be leasing a property through third party, but you need to adjust and make sure that that is not if that is operating lease, you adjust accordingly, or if it is a financial lease. As I was saying earlier, this is going to bring you to a benefit stream. You are looking at a benefit stream. Once you have that, you're trying to estimate what is the growth potential of this benefit stream. Is it a consistent growth? Is it increasing growth? Like, if it is startup in Silicon Valley, the growth might be significant in first 5-10 years, and then it will slow down, or it will become like a normalized growth. And again, you want to understand how this benefit stream that you have kind of trying to come up with gets impacted by tax. So, looking at different aspects of qualitative and quantitative analysis leads you to financials that you can use for the valuation purpose. And this is the what part. So when you're talking to analysts, or when you're trying to select an analyst, you can communicate with them what are the different ways the valuation should be done. So going back to Aaron U. Jones, they have a timber business, a sawmill, and a timberland. The timberland is one type of business, and a sawmill has a different dynamics. So valuation, there are three different valuation approaches: income approach, market approach, and asset approach. An income approach, going back to the sawmill example, sawmill has a revenue. There is a trend to that, and you can kind of project what will be the future of that revenue. That will give you a type of a cash flow. That cash flow you can use to project the value. That's the income approach. So there are commonly within each approaches there are different methods, and the three methods within income approach, at least three methods within an income approach, is you are capitalizing a cash flow, or you are creating a discounted cash flow model. And one more way is to use the dividend paying capacity. So company might be paying a dividend, or they might not be paying a dividend, but what is the capacity to pay dividend? That can be used as a reference. Going back to IRS revenue ruling 5960, it suggests that you should be using all three approaches. And if you don't use one approach over other, you kind of have to justify why not. And most of the time you'll see that there are multiple approaches and multiple methods used to come up with a valuation. The market approach is a second type of approach. Think of this as a comp for your home value. If there are houses on your street that's sold for X number of dollars, then your chances of your home or your house to be valued at that price is very high. That's the market approach. In case of Aaron U. Jones, you have a timberland. You're trying to identify, are there other timberland transactions that has happened in near past, and can I use that as a reference point? Or you can use public company information or private company information is available. So that's the basic idea about market approach. Are there similar transactions that you can find either from public or a private market? Asset approach is another way to think about value. So in case of Prince, for example, he has an asset which is his real estate. He has an asset which is the songs that he owns. He has an asset which is connected with his name and a brand name. So those are type of asset that kind of needs to be valued using asset approach. But you can also think about a regular business that you can value based on assets. So what you are doing is you are readjusting the balance sheet to come up with a value of the asset of the company. Basically, it's economic value of that business based on the asset. And the common methods that are used are book value, adjusted and net asset value, excess earning method. This is the method that is used. What is the excess earning that the company is enjoying because the asset that they have compared to the other industry comparables? So after you have all this analysis done, after you have economic, industry, and financial analysis of the business done, and after you have applied all the approaches, what you are trying to do is do a sanity check. And that's where the question in your mind should be, does this make sense? If the value of a business comes up from the income approach, from the market approach, from the asset approach, is significantly higher than someone would pay for it, it doesn't make sense. So there are, sometimes the industries have rule of thumbs. In financial advisory business, for example, they there is a rule of thumb, there is revenue multiple. If it is 2 multiple or 2.5 or 1.5, that's the comparison for the sanity check. There are data available from the public market that people can look at to understand this numbers that we kind of come up with. And we talked about level of valuation. Different level of valuation has a different discounts that needs to be applied. So once you analyze the economy, industry, and business, then you analyze the valuation using different approach. And lastly, you have to apply different discounts to that value. And this is where the fun comes in. This is where the subjectivity comes in. In case of Aaron U. Jones, the company used one discount and IRS is using another discount. Now, whoever can justify the best, that kind of stays. There are two main type of discounts. One is called discount for lack of control. So if it is a minority owner, they don't have the same rights. They don't have the same ability to control that business. And there has to be discount applied for that. Usually it can range from anywhere between 5 to 30, 35%. You look at the external data. There are a lot of data sets available for this type of discount information. And then you use that to come up with your subjective number. The most important thing here is you have to justify. If you have a right approach and right justification, then it cannot, people will accept that. The second type of major discount is lack of marketability. I mentioned this earlier too. If a business cannot be easily marketed, then there has to be discount for that. Again, lack of marketability discount, you have a data available that you can use. There are transactions that happens in public market, there are transactions that happens in private market. You can use those as a reference points. There are other type of discounts, but it's a lot of information that we can't go into today. The end product of all this exercise is a valuation report. And you as an advisor, when you get the draft copy of the valuation report or a final copy of the valuation report, the question in your mind should be, are all the professional standards properly applied? Is the analysis in detail? And is it well supported? Other part of this valuation report can be what type of report you are getting in your hand. Depends on the purpose, the premise, the level of valuation. So if you are just valuing one asset and there is no revenue from that, we recently analyzed LLC, which owns only public company, or actually public company, which is a SPAC, special purpose entity, acquisition entity. And the value of that business is just that one asset. And so there is not a lot of analysis that needs to go into it in terms of different type of approaches. So you can create a calculation of the value, or you can do conclusion of a value. Conclusion of a value is a much broader report. Calculation of value is much narrower report. There is a whole ecosystem of the valuation space. And you need to ask questions about, are you using the full ecosystem, or your analyst is using full ecosystem? Let me touch on different groups that are connected with valuation. There are professional organizations, for example, AICPA, National Association of CVAs, um, other associations are ASA, IBA. They all have their own valuation related designation and valuation related standards. Over time, those standards are becoming one. But these are the different professional organizations that you should be aware of. Of course, there are regulators in this ecosystem: IRS, state tax authority, and they become critical as they go through different analysis on different valuation and then come out with revenue rulings. Of course, tax courts are a huge part of the ecosystem. Most of the time, when the one judgment comes out, that has long repercussion on how valuation analysts think about uh, applying different methods, different discounts, different approaches to evaluation. In case of Aaron U. Jones, it impacted how one should think about S corporation, how one should think about um, discount for lack of marketability, how one should think about two different entities that are treated as one. Uh, but that all came from the one court case. Uh, then there are databases that I mentioned. If you want industry numbers, there is a database for that. If you want interest rate, there is a database for that. If you want um, comparable company information, there's a database for that. So all those database has to be accessed. And of course, valuation analyst doesn't do its work in silo. Sometimes you need other appraiser, real estate appraiser, um, the intellectual property appraiser. So those appraiser kind of add value, uh, and that becomes part of the full valuation report that you should be seeing. These are the different entities that kind of are the players in the space. So I want to kind of bring back those two cases that I mentioned. The first case was uh, about Prince versus IRS. It's not still resolved, but in that case, there are different type of assets that's been valued. You have real estate, you have intellectual property, you have actual business, music industry business, and the subjectivity that comes are in multiple places. What discounts you apply, what is the projected revenue that you think about, what is the value of the intellectual property that you think about. In case of Aaron U. Jones, same thing. A lot of places that you can have a subjective information. How you come up with the future earning has a subjective analysis. What interest that you use to discount the future cash flow has a subjective analysis. What happens to the discount that you apply has a subjective analysis. So as an advisor, what you need to think about is what are the right questions that you should be asking to different, either your client that would give you why the valuation is done, or when the valuation should be done for, and then ask the right question to valuation analysts about how are they going to go about and what approaches are they going to use. So let me stop here, and I want to bring Evan back and to wrap up, and then we can open up for question and answer.
Okay. Hi, do you hear me?
Yes.
Hi, thank you, Ninish. Do we want to send out one of those polling questions now, perhaps?
Sure, I'm ready to launch.
Just ask the last one that I had.
Yeah, let's just do the last one since we just were fresh off that.
Okay. How
Should
far
I wait?
apart are the IRS and the appraiser on Pop Singer Prince's estate valuation?
Yeah.
Yes.
Okay. All right, so that is launched. You should be able to see that. So there's three numbers that you can pick from, and remember to hit submit after you choose your answer.
Okay. Should I continue with the wrap up, Monica? Or
We're getting answers pretty quickly here, so
all right. Okay.
I'll share the results in just like 10 seconds.
Okay.
Looks like we
Oh,
have.
we have a few more minutes, anyways.
Yep, we're doing great on time. So we've had almost 65% of the attendees have responded to that.
Oh my God.
So I will share those results.
Yeah.
All right. There you go.
Most of them were right.
Yeah.
Yeah.
So
Very
the
good.
80.9 million is the correct answer?
That was
Yes.
it. Yep.
Okay, so almost or over half of the respondents picked that one.
And
Great.
do you want to ask one more?
Or should we wait? It's up to you.
Either way.
Yeah, it's okay. Good. So, Evan,
Why don't I do the wrap up? Why don't I do the wrap up? Then we'll do one more, and then we'll do Q&A. How about that? Okay. So Ninish, thank you so much for sharing your wisdom. Valuation can be both a dry and a complex topic, and Ninish has a real knack of simplifying it and making it at least a little bit interesting with the cartoons and such. So I'm going to do a summary. We started off with the cartoon that said, valuation is the answer, but what are the questions? So Ninish is a big question guy. He believes in the power of questions, and we have 2 ears and 1 mouth for a reason. So he asks good questions, and the 5 questions that he's encouraging you to ask your client are, in the context of valuation, are why, how, when, what, and who. So the first question, why? What is the context of the valuation? What's its purpose? Is it for gift gift tax and estate tax planning? Is it a buy-sell agreement? Are you negotiating with lenders? What is the reason? Now, on a personal note, I'll say one thing. Most of your clients will probably come to you when they need the valuation and when it's required and they want to get it done yesterday. But I could tell you from personal experience as a business owner, I think every owner should have a valuation, even if they don't need it. They should do it every 3 to 5 years. When I did my valuation, it was a truth test. When the analysts started asking me all these questions and coming up with all these documents and all these data, I had to look in the mirror and see how organized I was as a business owner and what the true number, what the true value is, not what I think it is in my head. So the context is important, but I would encourage every owner to have a professional valuation, I would say every 3 to 5 years, even if they don't need it. Anyway, that's the why. The second question is, how are we going to value the company? Is it going to be qualitative, quantitative, or both? It's typically going to be both. The qualitative is the art, and the quantitative is the science, is the data and the numbers. So it's going to be a combination of both data and qualitative and quantitative, both art and science, data and other soft questions that the analysts will ask. The third question is when, and that's so important. What is the valuation date? That's so critical. As Ninish said, a pre-COVID valuation date will yield, in many cases, a much different valuation than a post-COVID date. In a lot of cases, it's a lower valuation. In some cases, it's a higher valuation. The date is so critical in establishing what the value, because everything that leads up to the date matters. Everything afterwards doesn't matter. The next question is what method are you going to use to value the business? Ninish went through the 3 main methods: the income, the market, and the asset. The income is a present value of future cash flow. The market is comparables, like your house. What have other assets or business entities sold for? And the last one is the asset. If an orderly liquidation will provide a higher number than either income or market, we could use the asset. And Ninish mentioned that revenue ruling 5960, the IRS wants to see all 3. Now, if you're not showing all 3, it wants at least a justification why you're not showing the other 2, income, market, and asset. And then the last critical question Ninish came up with was who? Who's the analyst? Who's going to perform the valuation? Do they have the right designations? Do they have the right experience? Are they qualified? Are they a subject matter expert? And is it something that they could explain that is backed by reasonable data? And can the analyst serve as an expert witness, either if the valuation has to go to court or has to be argued in front of the IRS? Very important, who is performing the valuation. So there you have it. Why, how, when, what, and who. Business valuations, the Swiss Army knife of financial documents. And that wraps up the program. I think we're going to do if we have time, Monica, we'll do one more poll question, and then we could open it up. We have a good 10 minutes for any questions that anyone has. It's been a pleasure for us to spend time with you today. We very much enjoyed it. As Monica's showing here, there's an attendance verification code for states that need proof of attendance. And again, my name is Evan Levine. Feel free to contact me by phone or by email if you have any questions about the content in this program. And it's been a pleasure being with you today. Thank you.
Thank you very
Monica,
much, Evan.
Can you put a
Good.
polling question? One more
Sure.
polling question, please.
I just wanted to read out that code real quickly. That was lowercase g, capital G, C as in Charlie, T as in Tango, M as in Mike. And the next, we can do both questions. There is
Okay.
one on what's the first detail to clarify an evaluation assignment. Would you like to launch that one?
Sure.
Sure.
That should now be showing on your screen. So you can pick purpose, method, or approach as the first detail to clarify an evaluation assignment. All right, I'm closing that poll and sharing the results. It looks like purpose wins. 95%.
All right.
At least we thought
Hey.
something.
Yeah.
We can skip the third question. Monica,
Okay.
we can just jump
No
into the Q&A. Thank you.
Okay, so I'm stopping. So you can close that poll window if that's still showing for you. And we did have a couple of questions come through. Could you talk a bit more about valuation discounts, what different types are used, and when are they appropriate?
That's so I touched on two valuation discount broadly. One was valuation discount for lack of control, and second was valuation discount for lack of marketability. And generally speaking, in a private entity, there is always a valuation discount for lack of marketability. And lack of control is not always present. Lack of control is mostly applied to minority ownership. If you are only transferring part of ownership that you have, that might create a minority ownership. That's one way of thinking about it. Or you are a minority owner of a business, and that needs to be valued differently with the use of discount. There are other type of discounts that happens, like a key person discount, or there are legal restrictions that business has. Those are discounts that you apply in particular cases. But generally speaking, discount for lack of marketability, which is DLOM, is always applied, and DLOC, which is discount for lack of control, is applied most of the time.
Okay, thank you. We have another question that came in. I also want to know what types of financials do you need? How many years? For example, monthly cash flow for how many years, etc.
Yeah. So as more is better, that way the analyst can really understand the trends in the business, the changes that has happened, and how different economic environment impacts the business. But you can't get more. If you can get 5 years, that's great. If you can get 3 years, that helps. Some businesses are relatively new, and you might not have historical numbers. So then you have to use another approach to value the company. But more the better. And generally, it's balance sheet, income statement, and of course, cash flow.
And interviews.
Yeah, there is a lot of information that you
Yeah,
need,
site
but
visit.
in terms of numbers, that's the first
Yeah.
thing that you need. That's just a starting point. You need to understand, each balance sheet item. Do you need to readjust them? So you need to figure that out. Each income statement items. You need to understand whether that makes sense in the economic, broad economic perspective. And yeah, you need to, and that's all the exercise that analyst has to go through to really make sure that what numbers are available make sense to use for the valuation purpose.
Thank you. Do you always have to go through all three valuation approaches?
Mm, IRS Revenue Ruling 5960 suggests that. So as Evan mentioned, if you can't use all three, you have to have a good justification. But you don't, it's totally possible that you can't use all three. I mentioned this one example about a LLC that has no operation, just asset. So I was able to use market approach and asset approach, but no income approach because I don't have any income that I can use. And then you can justify that. But that's from the fair market value perspective. But sometimes a business owner or a client just want to understand one type of value, and the purpose could be completely different. It's not for our IRS. It can be just an internal valuation. And I mentioned to you about this bridal gown company. They just want to use asset approach because that's what they are using for their internal purpose. But if you're submitting to IRS, you want to submit with all approaches possible, or if not, good justification for not using one. The one more thing, sorry, I should add is
sure.
you don't have to average the value of all these three approaches. IRS doesn't tell you to average them. You can talk about all three. You can come up with the valuation, but and then you can use just one, or you can use all three with a different percentage of each. But you want to kind of analyze business from multiple perspectives.
Thank you. The next question, and apologies if I say this wrong, but what sources value national industry margins?
Oh, so there are a bunch of places you can get this information from. Bloomberg has that information. StockWow has that information. There are a lot of and S&P has that information. So there are a lot of industry references that you can use to get industry margin. IRS has that information. Although IRS's data is a little bit stale, they are usually 3 years behind in terms of gathering. But IRS has access to all financials of almost all companies, and they compile them by industry, and you can access them. Actually, it's available for free on their website.
Next question, can you give us a brief checklist for reviewing whether a valuation is adequate?
We can, there is I use a checklist to make sure that the report that I'm generating has covered all the bases, and I can point you to that. So, here is the email address that you can use. Send an email, and we'll send you the checklist.
Thank you, Nainish.
Sure.
Next question, are we responsible for the due diligence in terms of facility visits, etc.?
You can do you do the best you can. If it is a divorce case, and you are trying to get a value of a business of the other partner, you won't get access to a lot of this information. So you do the best. But generally, if you want to get access to the facility, you want to get access to the key management, you want to talk to them.
You mean the analyst? Yeah, I think what is it? Are we responsible if a site visit is necessary, who's responsible? That would be the valuation analyst that would do the site visit if it's necessary.
Correct, correct.
Yeah. It's the analyst who's responsible for that.
Right.
Okay, great.
But advisor will make a right connection so that analyst has access to that.
Right.
Yeah.
Exactly.
What, excuse me, what revenue ranges do you work with?
Personally, we, from anywhere from 1 million to 50 million. So we have a wide range.
Wide range.
Some businesses have multiple international operations that would be out of our skill set, but we can do a couple of countries. Like one business that we are dealing with right now has operation in Canada and US, and that's not very difficult to do. What you need is you need to gather up all the information first, and if you have access to information, then it becomes easy.
We have a follow-up to that question. Or is there a particular type of business profile that is of interest? And what is the range in cost for a business valuation?
You want me to
I'll
take
take the first part, and you can take the second part.
Okay.
Evan, I have an engineering background, so my specialty is technology and engineering, but that just doesn't limit. It's my interest more so than my specialty. I am really, I have a lot of skill set on understanding technology business. But, recently I mentioned about that SPAC, SPAC, which is, a lot of SPACs coming out in the public market. And I think we are probably one of the only one who has done a really good analysis on that. And I think we are specialized in that. But do you want to take a second question?
Yeah. The agreed fee for professional valuation can range, I would say, on a low end of a flat fee of $6,000. It could go all the way up to $50,000 if it's extremely complex. So it really is going to depend on the complexity and the time that's involved in preparing the valuation. As Ninish said, we can value any business, public and private, but because Ninish has this Wall Street background and was a real a specialist valuing public companies, he has a pretty unique insight into these SPACs, the special purpose acquisition company, as well as hedge funds and private equity and intellectual property. So we could do any business, but I'd say we do have a pretty unique view of some of these more complex assets, as well as the technology and the limited partnerships. But any business, we don't value real estate in and of itself. We value businesses and entities that hold real estate. We will not value artwork or private homes, but it's public and private businesses, as well as these other complex entities.
Yeah, and it can be operating company or non-operating company. Either way, we have a good understanding on the valuation process for that.
Great. Thank you both so much. We will wrap it up. Thank you to Ninish and Evan, and thank you all for joining us.
Okay.
Have a great afternoon.
Thank you.